Welcome back, everyone, to The Deep Dive. It's November 3rd, 2025.
And today we're doing something special as part of our series, OEOJ Agent UE American Stock Story with Toomey.
That's right. We're taking a really close look, a deep dive into SoFi Technologies. The ticker is SoFi.
Yeah, we've got a stack of materials here, their latest Q3 results from 2025, strategy documents, the works.
But the mission today isn't just to read off numbers. We want to cut through the noise,
Exactly. Give you, the listener, a really solid, balanced view. Look at the good, the potential risks, too.
Because SoFi's model, it has these incredible strengths, but there are definitely complexities, big ones.
Especially for a company growing this fast, trying to disrupt finance.
Okay, so let's unpack this. Why SoFi? Why now? Well, look, they're not just aiming to be another bank.
No, not at all. They want to be the operating system for your entire financial life.
Like a one-stop shop, fully integrated in a way maybe legacy banks just go.
Precisely. Think about it if they can own that whole relationship. Saving, investing, borrowing, everything.
The potential market is just huge, especially targeting younger, digitally savvy generations. That's like, what, half the U.S. population?
A massive opportunity. Okay, let's get into it. Right, so to really get SoFi today, you have to see where they came from. Founded back in 2011.
And they started pretty niche, didn't they? Focused on student loan refinancing.
Yeah, specifically private student loans, often for high earners, but they expanded fast. Now their whole mission is summed up in that phrase they use, get your money right.
Which sounds simple, but it means having a whole suite of products, right?
Absolutely. It means helping members borrow better, save better, spend better, invest better, and protect better. It's meant to be this complete ecosystem.
Okay, so to build that kind of ecosystem, you need the right structure. And they report across three main segments, yeah.
Correct. Three highly connected segments. First up is lending. This is their historical core.
And it covers the whole process. Application, underwriting, funding.
The whole life cycle. And while student loans are still there, the big product now is personal loans.
Plus home loans, they seem to have everything there. Agency, non-agency, VA, FHA, ALOCs too.
Yep, a really broad portfolio. It helps them capture demand no matter what the economy is doing, theoretically.
But the secret sauce isn't just the list of loans. It's how they decide who gets one, isn't it? Their underwriting.
That's a key point. They don't just look at your FICO score. I mean, they use the standard credit reports, sure.
But they layer on top their own custom models, looking at things like free cash flow.
Exactly. Free cash flow, education history, things that help them identify high-quality borrowers, often people with good incomes who might actually get overlooked or get worse rates from traditional banks. It's proprietary.
Okay, so that's lending. What's the second segment? Financial services.
Right. Financial services, think of these as the products you use every day. They're designed to build trust, keep you coming back to the SoFi app. It's about engagement.
So this is where the stickiness comes from.
Precisely. If lending is the big transaction, financial services is the daily habit.
So what's included here? Things like SoFi Money, their checking and savings.
Yep, the checking and high-yield savings accounts run through SoFi Bank. That's crucial for bringing in those low-cost deposits we need to talk about later.
And investing. SoFi Invest.
A whole platform. Active stock trading, robo-advising, even level I options trading now. And they launch these headline-grabbing products too, like that SoFi Agentic AI ETF.
Right. And then there are the everyday tools. The SoFi credit card.
Yeah, designed to compete with your regular card's cashback, no annual fee, no foreign transaction fees. They've got 3 types now.
Plus things like SoFi Relay for tracking your finances, credit score.
Aggregates everything. And SoFi Protect for insurance, link through partners. And even SoFi Pay, that's their crypto remittance thing, right?
Yeah, it's a really wide net they're casting, trying to cover all the bases.
It really is an ecosystem designed to make you stick with the platform.
Okay, and the third piece, the technology platform. This one feels a bit different.
It is, and it's often overlooked, but you could argue it's their biggest long-term advantage. Their moat, maybe.
Because this isn't just for their own products. They sell this tech.
Exactly. It powers SoFi internally, but they also sell these capabilities to other companies' enterprise clients.
And this came mainly from acquisitions like Galileo and Technisys.
Primarily. Galileo is a platform as a service, handles the complex back-end stuff, account setup, payments, funding. Technisys adds that modern, cloud-based core banking platform.
So owning this tech stack, what's the big deal?
2 massive advantages. First, it drastically cuts their own operating costs. They're not paying license fees for some old, clunky legacy system.
Okay, that makes sense. Lower internal costs.
Second, They make money selling this powerful infrastructure to others. They're taking Technices global, especially into places like Latin America. They're not just a lender, they're selling the actual plumbing for modern digital banking.
Got it. So lending, financial services, and the tech platform all working together. #2, market strategy and growth engine.
And that integrated model leads us straight to what they call their strategic masterpiece, the Financial Services Productivity Loop, FSPL for short.
FSPL. Okay. And they see this as their core competitive advantage.
Explicitly, they call it their sustainable competitive advantage. It's the engine driving their growth. It's like a flywheel.
All right, walk us through how this flywheel or loop works. It starts with brand awareness.
Yeah, get the name out there. And the sources say it's working brand awareness is hitting record highs. Like unaided awareness hit over 9% in Q3. That brings people in the door.
Okay, so people know SoFi. Then what?
Then the loop hinges on offering that full suite of products we just talked about and making sure they actually deliver superior value, help people manage their money better.
If the products are good, that builds trust.
Trust is the key ingredient because trust leads directly to the next step, cross-buy, or X-buy as they call it.
Cross-buy, meaning someone uses one SoFi product, then adds another.
Exactly. Maybe you start with SoFi Money Savings, then you take out a personal loan or open an investment account.
And why is that so important?
Because it crushes their customer acquisition cost a sec for that second, third, fourth product. It makes each customer relationship way more profitable over time. Higher member lifetime value, or LTV.
Ah, okay.
Yeah.
Lower CAC, higher LTV.
And that higher LTV generates more profit, which they can then reinvest into making the products even better, developing new features, which attracts more members, builds more trust.
And the loop reinforces itself.
Yeah.
It spins faster.
That's the idea, sustained growth.
And who are they targeting with this loop?
It's pretty specific. Digitally native generations, obviously, and high-quality borrowers, typically households earning $100,000 or more.
That focus on high earners ties into how they compete with traditional banks, doesn't it?
Absolutely. It brings us to something really interesting in the source material. Let's call it the personal loan thesis.
Okay, I'm intrigued. What's the thesis?
The argument is basically this. Big traditional banks, often stuck with old tech and focused on easy profits, they actually prefer high-income customers to carry big credit card balances.
Why? Because the interest rates are sky high, like 25% or more.
Exactly. It's incredibly profitable for the banks. So the thesis goes, if you're a high-quality borrower, someone who will pay back their debt, and you want a personal loan to consolidate that expensive credit card debt at a lower rate.
The traditional bank doesn't really want to give it to you. They'd rather keep you paying that high credit card interest.
That's the core argument. They're disincentivized. This creates this huge gap in the market, an unmet need for fair, competitive personal loans specifically for these high-quality borrowers.
And that's the gap SoFi jumps into.
Beautifully, they offer exactly that. Transparent, lower-rate personal loans to that specific group. It's a direct challenge to the traditional model.
It's a pretty bold claim, essentially saying big banks are kind of trapping their best customers.
It is bold, but it explains why SoFi's personal loan business took off. They found a segment the incumbents were arguably underserving or serving poorly.
And we're seeing proof this FSPL strategy is working, looking at the Q3 numbers.
Oh yeah, the growth engine is definitely firing record numbers.
Like new members.
Added a record 905,000 new members in Q3 alone, and a record 1.4 million new products adopted by members.
Wow. But the really crucial metric is that cross-buy rate, isn't it?
That's the one. The ultimate proof the loop is working. Class buy or X buy hit 40% in Q3.
40%, up from 35% just the quarter before.
Exactly. Think about that. Nearly half of their new members are adding a second product pretty quickly. That jump from 35% to 40% in one quarter, that's huge.
It shows the flywheel is really accelerating, lowering acquisition costs, boosting that lifetime value.
It's strong evidence their core strategy is paying off.
Okay, so the strategy seems to be working. Let's shift to the financials themselves from Q3 2025. The picture here looks, well, pretty positive, right?
Unequivocally positive, I'd say. They hit some major milestones, showing real strength and profitability.
The big headline has to be GAAP net income, yeah.
Absolutely. $139 million in Q3. That's a 14% GAAP net income margin. And maybe even more importantly, it's their 8th straight quarter of being GAAP profitable.
8 quarters. That really pushes back against the idea that they're just a growth-at-all-costs fintech. It shows the model can actually make money.
Right. It proves viability over the longer term. And the top line was strong, too. Record revenues.
Adjusted net revenue hit $950 million. That's up 38% year over year.
Huge growth. And operationally, they're getting more efficient. Adjusted EBITDA also hit a record, $277 million. That's a 29% adjusted EBITDA margin, which is pretty impressive.
So strong profits, strong revenues, strong margins. What's enabling this? You mentioned the bank charter earlier. Is that the key?
I think it's the absolute bedrock. The bank charter they got back in 2022 provides funding stability. And that's arguably their single biggest structural advantage over fintechs that don't have one.
How does that work exactly? It lets them take deposits.
Yes. And those deposits are growing fast. They added $3.4 billion just in Q3. Total deposits are now nearly $33 billion.
$33 billion. Wow.
And here's the kicker. Deposits now fund about 90% of their loans and assets. That's up from just 57% back in 2022.
90% deposit funded. So they're much less reliant on, like, borrowing money from other banks or selling off loans.
Much less reliant on more expensive, sometimes volatile funding sources like warehouse lines or the securitization market. They're using stable, relatively low-cost deposits from their own members.
And the cost savings must be enormous.
Staggering. The source estimates this shift to deposits is saving them around $627 million a year in funding costs annually.
$627 million. That's a game changer for margins.
It gives them incredible flexibility. They can reinvest that money, offer better rates to customers, or just let it flow to the bottom line. It's a massive competitive edge compared to rivals paying much more for capital.
And it helps with regulators, too, being well capitalized.
Definitely. As of mid-2025, their capital ratios were well above the thresholds needed to be considered well capitalized. That's a crucial stamp of health for any bank holding company.
Okay, so the charter is huge. But SoFi doesn't want to be just a lender, right? They're aiming for diversification. How's that going?
It's showing up strongly in their fee-based revenue. This proves they're becoming less cyclical, less dependent purely on loan interest.
So revenue from things other than lending.
Exactly. Fee-based revenue hit $409 million in Q3. That's up 50% year over year, and it now makes up 43% of their total adjusted net revenue.
Almost half their revenue is non-interest income now. That's significant diversification.
It is, and if you isolate the revenue just from the financial services and technology platform segments, the non-lending parts, that was $534 million in Q3, up 57% year over year.
So those segments are growing even faster than the company overall. That really shows the FSPL is working to create multiple income streams.
Makes them much more resilient if, say, lending slows down. And a big part of that fee growth is coming from scaling up their loan platform business, the LPB.
That's where they originate loans for other partners.
Right. They originated a record $3.4 billion through the LPB in Q3. That's almost $1 billion more than Q2.
And even if they sell those loans, they collect fees.
Substantial platform fees. In Q2, for instance, the LPB generated over $127 million in fees, plus ongoing servicing income. It shows their origination and underwriting engine itself is a valuable, profitable product they can sell.
Okay, one last positive point. Credit performance. How are the loans actually performing? Are people paying them back?
This is critical, especially for their main product, personal loans. And the data looks good.
Good hell.
Net charge-offs loans going bad actually declined slightly in Q3 for personal loans, down to 2.60%. That's actually better than their own internal models predicted.
So their underwriting seems to be holding up, even with economic uncertainty floating around.
It appears so. And they also mentioned tightening standards for their credit card, which led to delinquency rates falling significantly compared to last year. It suggests that focus on higher-income borrowers is providing some cushion against broader credit problems.
Okay, that's a lot of positive momentum.
Yeah.
Impressive numbers. But, no company is perfect. For a balanced deep dive, we have to look at the other side, the risks, the challenges.
Absolutely essential. And there are definitely things to watch closely, especially for a company moving this fast in finance and tech. Let's inject some friction here.
Where do we start? Credit quality seemed like a strength, but you mentioned nuances.
Right. While personal loans look solid, the source material did flag a specific short-term issue in the student loan portfolio back in Q2 2025. Something that needs a closer look.
What was the issue?
The annualized net charge-off rate on their student loans for that quarter hit 0.94%.
Okay, is that high?
Well, it was higher than the rate they assumed in their models, which was 0.67%. So reality temporarily drifted above their expectation.
So why did student loan performance slip, even temporarily, if their underwriting is supposedly so good?
That's the million-dollar question, isn't it? The company provided two main explanations in the source material.
What were they?
First, they said most of the increase was due to operational-related charge-offs, during a transition to a new company that services the loans, a subservicer.
Operational issues.
Okay.
And the second reason?
Second, they mentioned strategically buying back some older, seasoned loans near the end of Q1 that just inherently had a higher risk of default.
Okay, hold on. Attributing higher defaults mainly to an operational transition. I mean, is that a standard explanation, or does it feel a little convenient? Could the model have actually missed something?
That's where the skepticism comes in. It's a fair question. While operational hiccups during transitions do happen, you're right, it could also mask other issues.
It highlights the risk of relying on third parties, even for servicing, right?
Yeah.
Any transition creates potential for errors that impact the numbers.
Exactly. It's an operational complexity risk. The market will definitely be watching the Q3 and Q4 numbers to see if that student loan charge-off rate comes back down sharply, confirming it was just temporary.
Right. Okay, moving beyond specific loan types, what about bigger picture risks, macroeconomic stuff, interest rates?
Still a major factor, even with the bank charter's benefits. High interest rates, or even just the uncertainty around them, definitely dampen demand for refinancing products.
Makes sense. If rates aren't clearly lower, why refinance your student loan or mortgage?
Precisely. So even with rate cuts expected maybe later in 2025, that uncertainty can still act as a drag on loan origination volume.
And there was something about their cash flow being different from a traditional bank, more tied to originating and selling loans.
Yes, this is a crucial distinction. Their operating cash flow is heavily dependent on that cycle. Originate loans, then sell them or securitize them. This shows up when you look beyond just the GAAP profit.
How so?
Well, in the first half of 2025, their net cash used in operations was huge, like $1.45 billion used.
Wait, how can they be GAAP profitable but burn through that much cash in operations?
Because they originated loans held for sale much faster than they actually sold them or got paid back. Think of it like they're building up a massive inventory of loans on their balance sheet.
So they're spending cash up front to create these loans.
And relying on being able to sell them later to get that cash back, plus a profit.
Which means they're really exposed to the health of the capital markets, right?
Yeah.
If the market for selling loans dries up or prices fall.
Exactly. That $1.45 billion cash burn highlights a structural vulnerability. If they can't efficiently sell or securitize those loans, they could face a serious cash crunch, even while reporting GAAP profits.
Okay, that's a big one. What about regulatory risks? You mentioned the bank charter brings stability, but also complexity.
Immense complexity. Being a bank holding company, a BHCA, means they're under the thumb of the FDIC, the OCC, the Federal Reserve. Tons of rules.
So they get the cheap funding, but they also get the bureaucracy.
Pretty much. They have to meet strict capital requirements, comply with covenants on their debt, state-level rules. It's a heavy compliance burden that can definitely slow down innovation compared to a non-bank fintech.
And does that risk increase as they push into newer areas like crypto?
Absolutely. Their ambition in crypto, like SoFi Pay or plans for crypto-backed lending, exposes them to a whole new layer of complex, rapidly changing regulations.
Things like how they handle custody of crypto assets.
Yeah, the source mentioned needing to comply with things like SAB 122 from the SEC. Plus, you have the inherent risks of crypto itself. Massive price swings, security breaches, counterparty risk if someone they work with fails.
So every new feature adds another layer of risk and compliance costs.
It really does. Finally, just a quick note on something technical but relevant. Insider activity and compensation.
What do the sources say?
Just reported neutrally that a couple of top execs, the CTO and CRO, set up scheduled stock selling plans, Rule 10b5-1 plans, back in June. Pretty standard stuff for executives.
Okay, planned sales. Anything else on compensation?
Just the scale of share-based compensation. It's a non-cash expense, but it was significant, $127 million in the first half of 2025 alone.
So while it doesn't burn cash, it does reduce their reported GAAP earnings quite a bit compared to adjusted figures like EBITDA. Important context for investors.
Definitely. Necessary to attract tech talent, but it impacts the bottom line number. #Tech5, future trajectory and outlook.
All right, so we've covered the business model, the growth engine, the strong Q3 results, and some significant risks. Where does SoFi go from here? What's the future look like?
Well, their trajectory seems clearly focused on two things: doubling down on their technology advantage and fully exploiting that stable funding base from the bank charter.
The tech edge. You mean pushing even further into advanced areas?
Yeah, their ambitions are pretty big here. The sources mention wanting to provide full banking services, handling both regular money and crypto for major crypto companies. Think Paxos, BitGo, Talos.
So they want to be the bank for the crypto industry, the infrastructure provider.
That seems to be the goal. And not just custody or payments, but also getting into lending backed by crypto assets.
Wow, okay, that sounds cutting edge, but also pretty risky given crypto volatility.
Highly complex, definitely at the intersection of traditional finance and the new digital asset world. Big potential rewards in fees and diversification, but also significant risk.
And internally, they're still investing in AI and new investment products.
Continuously. Things like their AI-powered cash coach for personalized advice, rolling out that new agentic AI ETF, offering options trading. It's all about enhancing that core digital experience, making the app stickier, keeping the FSPL spinning.
And the bank charter provides the foundation for all this expansion.
It's the bedrock. Having diverse funding stable, cheap deposits plus access to traditional loan funding gives them flexibility, especially if capital markets get choppy again. That 90% deposit funding is a huge safety net.
How does this position them against competitors? You mentioned Lending Club or Upstart earlier.
Well, compared to them, SoFi's big advantage is that integration. It's the whole package.
So Upstart has the AI lending model, but no bank charter.
Right. So Upstart is totally exposed to funding costs. When rates go up, their margins get squeezed hard because they have to pay market rates for capital.
And Lending Club, they have a charter now, right?
They do, which helps. But historically, they've been much more focused just on personal loans. That makes them more vulnerable if that specific market slows down, like we saw happen to them during the early pandemic.
So SoFi's edge is, what, doing everything?
It's the vertical integration, owning the customer relationship, the app, the proprietary underwriting, and controlling the funding cost via the bank. It lowers their overall cost structure dramatically.
Meaning they can potentially be profitable at loan margins where competitors might struggle.
Exactly. Plus, they have those growing fee streams from tech and financial services to cushion them if lending does hit a rough patch. They're built differently, aiming for resilience across the whole financial spectrum, not just excellence in one niche. Hashtag tech outro.
Okay, let's try to pull this all together,
Mhm.
synthesize this deep dive. So SoFi is clearly showing really powerful momentum right now.
Yeah, record revenue, 8 straight quarters of GAAP profit, that impressive 40% cross-buy rate showing the core strategy, the FSPL, is really clicking.
And a lot of that success, that stability, ties directly back to getting the bank charter. The cost savings there are just massive.
Huge. But that stability comes bundled with significant complexity. They've got to keep a close eye on credit quality, like making sure that student loan issue was truly temporary.
And manage the sheer weight of the banking regulations, especially as they charge into really complex areas like crypto and advanced AI.
That's the tightrope they have to walk.
So maybe the final thought, a provocative question for you to consider is this. They have this incredibly stable, low-cost funding base. Thanks to the chart, it's almost like a license to print stability.
Right.
Can that financial stability successfully fuel their incredibly ambitious expansion into these high-tech, high-risk areas like being the bank for crypto without messing up their profitability or, crucially, eroding that high-quality loan book that got them here?
That's the multi-billion-dollar question, isn't it? Balancing that stability with aggressive innovation, that's what will define their success or failure in really capturing the future of digital finance.
It's the essential trade-off we'll all be watching. Thanks for joining us for this deep dive.
Thanks, everyone.
If there's a company you would like to know more about in the future, please leave a comment.